Hey guys, welcome to another video. Today we're going to cover the basic information that we must know before starting investing money in the stock market. I see a lot of people commenting and sharing posts on social media platforms that actually don't really know how the market works. So I've decided to explain the main aspects that we have to know in order actually to invest our money and not just betting on what is trending in the period. But before starting, please subscribe to the channel, click on the bell to get notified, leave me a thumb up and some comments if you got any questions. Let's start with the fundamental. What is a stock? We can explain with a simple example. We have Mr. McFarland that opens a restaurant in his hometown. Restaurant is going very well, business is good revenue, and he's very happy. So he decides to start a chain of restaurants, but to open new places he needs more money. So he's got two options. One is going to the banks for asking for more money, and the second one is releasing shares to the public via an IPO, initial public offering, which is when the business gets listed in the market. There's also FPO, which is follow-on public offer, which happens when a business releases more shares to the market, but they already have to be in the market, so they have already to have done the IPO. And then there's also the ICO, which is the equivalent of the IPO for the cryptocurrencies. But we're going to cover this in another video. And there are a lot of markets in the world based on the location. The most famous one probably is the New York Stock Exchange market, founded in 1792. In New York there's also Nasdaq, founded recently in 1971. And then we got something in Asia, Tokyo. In Europe we got the London Exchange market, and also in Italy Borsa Italiana and many others. And all the markets have different opening and closing times based on the time zones, and also different closing days based on the bank holidays of the country. However, all the stock markets are open during the day, Monday to Friday, so they are closed the weekends. The foreign exchange market, which is the currencies market, where you can exchange currencies, are open in 24 hours a day, Monday to Friday. And then we got the cryptocurrencies, which is a bit different because it's not regulated like the normal markets, and they're opening 24 hours a day, 7 days a week. And you probably heard about the index of the market, like the Nasdaq is up 1 point. It's a way to measure how that particular market is going, so how all the stocks listed on the market are going during the day. And some other terms that we're going to encounter are going to be bull market and bear market. That's quite interesting because the names derives from the way of how the animals attack. So bull market means that the market is going up. The bear market means there's a falling of prices. And when we got a sustained rise in stock prices, generally between 10 and 20% increase, we have a bull rally. If it is a decrease between 10 and 20%, is a bear rally. And we can have different type of rallies, can be secular rallies that goes between 5 and 25 years. We can have a cyclical rally, which is different months, an intraday rally, which is when a stock goes up 10-20% in one day. And let's see one last definition, which is the difference between investment and trading. An investment is a long-term investment. So for example, is when I buy a stock today to get a profit in 1, 2, 3 years time or more. Instead, trading is generally up to 6 months. So trading is when you buy and sell in a short-term period. We then have the daily trading, which is when you buy and sell stocks during the day, and that is followed by a technical analysis when you study the charts and trying to understand if it's a good trade for the day, but we're going to analyze that in a second video. And now that we got the basic information, we can start actually studying how to understand if a company is a good or bad investment. We have two types of different ways to analyze a company. One is the quantitative and the other one is the qualitative. The quantitative analysis are purely numerical, so they are mathematical indexes that you can analyze to understand if a company is a good or bad. One example is the P ratio, which is price per earning ratio, which is the current share prices divided by the earnings per share. Higher is this value, and more probable is that the company is growing. But that's not all. Something that we have to take into account is the qualitative analysis of the company. This is a little bit more tricky and difficult because it's not tangible. It's about the culture of the company, the name recognition. It's about the management, if people trust in the management of the company. It's about history, it's about the current times. There's a lot of different things to take into account. So it is essential that before you start investing, you actually study the company, you do your research, you understand what they offer, who's behind it, what's the management like, what's their vision in the short or long-term period. There's a lot of different factors that you have to take into account. So why share prices change value and can go up and down? Well, if a lot of people buys shares of the company, it means that they want to own part of the company and they trust this company. They like their direction, they like their products. So in that case, the price will increase because there's more demand. Opposite, if people sell their shares, means they don't want to own the company anymore, they don't trust it or they don't like it, and in that case the price goes down and the demand is less. And we can see and study all this in charts. We actually care just about two charts. One is the line chart and the other one is the candle chart. The line chart is a line, as per name, that connects all the closing prices of the share for every single day. And the candle chart in a way is a bit different. So per each day you got a high point and a lower point. So if the candle, if the rectangular is green, it means that it started from the lower point at the opening and it closed higher. So the share price increased during the day. If it's red instead, it means that it opened at the higher point and then it closed at the lower point. So you can see day by day what's the trend of the share. However, you can see something a bit weird. Between 2 days, you have actually a gap between the closing point of the day 1 and the opening of the day 2. And this is where actually most of the beginners make a mistake. Let's see this with an example. Nasdaq opens 9:30 in the morning East time, New York time, and closes 4:30. However, some broker allows you to trade even before the markets open, between 4:30 am and 9:30. That period of time is called pre-market. We then got an aftermarket after closing time. So the value of the share prices can change during pre-market, but most of the people can only start trading at 9:30. So something that I really recommend is never open an order when the market is closed, because the pre-market can really change the value of the share price. So for example, you order a share of Coca-Cola for $200 the evening before, but during the pre-market, the Coca-Cola share price increased 50%. So when the market opens, your order goes through, but you actually buys at the time of the market opens, so 50% more than what actually you ordered the night before. And that can be very dangerous because it can be at the top value, and then everyone sells their shares during the day, and then you ending up losing a lot of money. So bear in mind, there's a pre-market and after-market, so never buy or sell shares when the market is closed. Okay, buy and sell, actually, they are not the right terminology, because you open a position when you buy some stock, and you close a position when you get rid of the stock, so you sell the stock and you get the profit, hopefully. Buy is still meaning buy, which means you want the share price to increase because you buy at 10 and you want the share price to go to 20 to sell it again, and get a profit of 10. Sell is a bit different actually, because it's a bet the company is doing bad and the share price is going to decrease. So you want the share price to go down to make a profit. And you'll think, yes, but how this works? So bear with me a second. I'm going to explain in a very simple way. It's not probably exactly how it works, but that's probably the clearest way to understand. Okay, let's say that you use eToro as a broker. So you open a sell position. It's like if you borrow a share of a company XYZ from eToro. At the moment that you borrow the share, the price is $10 per share. And you know for some reason that the share price is going down, so you want to get rid of the share. So you borrow this share for $10, you give it to other users for $10, so there's no profit and no loss. But the share price goes down. For example, it goes down to $5 per share. You go to eToro and you say, you know what, I give you back one share. But at that time the share price is only $5, so I have to give them only $5. But the other users give me $10, so I got $5 profit. So that's more or less how it works. You see the brokers sometimes disable this option. That's the reason behind it. I'm not going to touch in this video. But it's important that you know that you can open a buy position and a sell position. Okay, so you can decide if you want to do a daily trader or an investor, investing in companies for a long-term period. And if you choose the second options, there's something that you really have to take into account, which are dividends. Dividends are just profits that the company is sharing with the shareholders. So if the company is doing well, they have a profit, and they share part of this profit with the people that got shares. Dividends are paid regularly to the shareholders, generally quarterly. Even when you have a bear market and the stock prices are going down, you still have a consistent income. The dividends are not affected by the stock price, but by interest rate. And that's another thing. A good example is Coca-Cola. Coca-Cola dividends are very good, are currently 3.5%. So let's say that every 3 months you get dividends. And instead of getting this money, you just reinvest them in the same company. So the curve of your profits is going to increase because you reinvest the dividends. Some companies also offer the DRIP, the Dividends Reinvestment Plan, that automatically reinvest the dividends in their stock. Okay, so far we've seen a big summary of what the stock market is and how to analyze companies. However, there's one last thing that I want to touch, which is bonds. Bonds are just loans, are money that a company can borrow from people in order to grow. There are two types of bonds, the government bonds and the corporate bonds. So government bonds are money that the countries ask people in order, for example, to build roads, and they have to give them back with an interest. So from an investor point of view, bonds are a safer way to diversify your investments. And the other one is corporate bonds asked by businesses to grow and raise capital. So let's see this with an example. You buy bonds of a company for the duration of 5 years for the amount of $5,000. So this company is going to give you back $1,000 a year, which is a 20%, plus a 5% coupon, which is the interest. So every year you get $1,050 back. At the end of the time, you will get $5,250, so it's $250 interest rate over the 5 years. Of course, this is going to be less than investing in stocks, but it's much safer because if you buy bonds of governments like US or Germany governments, you are pretty sure that you're going to get the money back. And also if you buy bonds of very serious and established company, you're almost sure that you get the money back. The interest is higher than leaving your money on your bank account. That's a very low risk, and it's a sort of win-win. Okay, that was all. Thanks for watching this video. It ended up to be a bit longer than we expected, but I hope that you found it useful and you now have the information that you need to start and invest in money. As always, I have to say I'm not a professional investor, so I do this for passion. I'm very passionate about stock markets and studying companies, so don't take my words like law. So I will never recommend to open or close positions, but I want to give you the information that you need to make the decision with your own head. As I said at the beginning of the video, please, if you like it and you want to see more content, subscribe to the channel, click on the bell and leave a thumb up.